TSMC completely crushed consensus for their Q2 2026 earnings. They missed nothing. They beat the top end of their own guidance across the board. Revenue came in at a massive 40.20 billion US dollars, which easily blew past that 39 to 40.2 billion projected range. Earnings per share hit 27.25 new Taiwan dollars. And gross margins, they hit 67.7%, just destroying the 65.5 to 67.5% guidance range. And, the market reacted immediately. The stock popped significantly right after the report dropped.
Yeah, and when you look at the year-over-year context, the scale of this is just wild. Revenue's up 36.0%, but the real kicker net income surged by 77.4% to hit 706.56 billion new Taiwan dollars.
Okay, let's unpack this, because for this deep dive, we're pulling directly from TSMC's Q2 2026 management report and their earnings presentation. And our goal here is to show you, the retail investor, exactly what is driving this massive growth under the hood.
Right, stripping away all that headline noise.
Exactly. We want to strip away the noise to focus on segment performance, the actual margins, and honestly, the real risks going forward, because there are some.
Oh, absolutely there are. I mean, when you see top-line numbers like this, you might just assume the whole semiconductor industry is perfectly fine. But as an investor looking at a foundry model, you really have to understand the underlying mechanics of how TSMC actually generates these returns.
Right. And before we get into, their massive capital expenditures, we need to talk about what they're actually selling. Looking at the technology breakdown in the report, a staggering 77% of their total wafer revenue now comes from advanced technologies.
Yeah, which they define as 7 nanometer and below.
Right, exactly. So think of TSMC's revenue mix like a really high-end restaurant, right? Almost 80% of the sales are the absolute most expensive cutting-edge items on the menu. And they just added a brand new ultra-premium dish.
The 2 nanometer node.
The 2 nanometer node, exactly.
Yeah, if you want the exact breakdown, it's pretty staggering. The 3 nanometer node is now 30% of revenue. 5 nanometer is 33%. And that brand new 2 nanometer, it's already accounting for 3% of wafer revenue in its early ramp phase.
Wait, 3% already?
Yeah, 3% of a $40 billion pie, just in the early stages.
That's incredibly fast for a technology that basically generated zero revenue just a couple of quarters ago. Tech companies must literally be waiting at the factory doors for these chips.
Oh, they are. And it's driven by a massive divergence in the end market platforms. If you look at the data, high-performance computing, or HPC now, makes up a whopping 66% of their revenue. And that segment grew 20% just quarter over quarter.
20%.
Yeah. Meanwhile, smartphones make up 22%, and that actually shrank by 4%. What's fascinating here is that this is a complete structural shift. HPC is clearly eating the pie.
It's just devouring the demand for the 3 nanometer and 5 nanometer nodes. HPC is basically all those massive data centers, right? The cloud infrastructure, AI training clusters.
Exactly. The hyperscalers are in an absolute arms race right now, so they're buying up every HPC chip they can get their hands on.
Yeah.
It completely decouples TSMC from the old smartphone upgrade cycles.
Which is wild, because smartphones used to be the undisputed kingmaker for TSMC. Used to just watch global phone shipments to predict their quarter.
Not anymore. Now you track North American data center spending.
Right. So let's pivot to profitability because, I have a bit of pushback here on the math.
Okay, lay it on me.
How is TSMC expanding gross margins to 67.7%, which is up 9.1 percentage points year over year, by the way, and operating margins to 60.3%, while simultaneously ramping up a brand new 2 nanometer node and building those incredibly expensive overseas fabs?
It sounds contradictory, right?
Yeah. Usually spinning up new nodes and building factories just drags margins down. Initial yields on new nodes are lower, depreciation is huge. How are they pulling this off?
Well, the margin bridge in the source data spells it out. It comes down to two things: aggressive cost improvement efforts and, crucially, massively higher capacity utilization.
Okay, capacity utilization. Explain that for the listener, because I feel like that's the secret sauce here.
It absolutely is. Think of a semiconductor fab like a commercial airliner. The fixed costs, the plane, the pilots, the fuel, are basically the same whether it's empty or full. Semiconductor factories are the ultimate fixed cost business.
Because those EUV lithography machines are, a couple $100 million each?
Exactly.
Yeah.
Upwards of $200 million a pop. You pay for that depreciation whether it prints one chip or a million. But right now, because HPC demand is through the roof, they are running these factories incredibly hot. They are filling every single seat on the plane, so to speak.
Which drives the cost per chip way down.
Exactly. That efficiency gain completely overpowered the margin dilution from those new overseas fabs and the 2-nanometer ramp.
Wow. Okay, but here's where it gets really interesting. Further down the income statement, there's a massive spike in non-operating income. We're talking a 95.83 billion new Taiwan dollar gain.
Yeah, that's a huge number.
Almost $100 billion in a single quarter. Where does that even come from?
So as a retail investor, you have to separate this one-off windfall from the core operational earnings. What happened was TSMC sold 8.1% of Vanguard International Semiconductor, or VIS.
Oh, so it's an asset sale.
Right. That sale resulted in a 63.20 billion new Taiwan dollar disposal and mark-to-market gain. So it's a huge boost to the balance sheet, obviously, but you can't extrapolate that forward into your future earnings models.
Right, because they can't sell that same stake again next quarter.
Exactly. Though, to be fair, even when you strip out that windfall, both their core operational earnings and margins are still incredibly strong.
Very true. Speaking of the balance sheet, let's talk about their cash flow and CapEx, because they spend US $15.70 billion in capital expenditures.
In just Q2 alone.
Right, in just 3 months. How does a balance sheet possibly absorb a $15.7 billion outlay without breaking a sweat?
Well, you look at their liquidity metrics. Despite that massive spending, their total cash and marketable securities actually increased sequentially.
Wait, increased after spending $15 billion?
Yep, it increased by 134.41 billion new Taiwan dollars, bringing their total to over 3.5 trillion new Taiwan dollars.
Yeah.
The operational cash engine is just vastly out-earning their capex. They generated 783.36 billion in operating cash flow.
That is just a fire hose of cash.
It really is. And if we connect this to the bigger picture, it shows what this means for you as an investor. TSMC is completely funding aggressive future-proofing. Like, the report mentions the A13 technology debut at the 2026 North America Technology Symposium. They're already funding the next generation out of pocket.
While still rewarding investors, right? Because the board just approved a 7.00 new Taiwan dollar cash dividend for Q1 2026.
Exactly. Which goes ex-dividend on September 16th, by the way. So they are building factories, developing future nodes, and paying out cash dividends all at the same time.
Amazing. But I did notice one metric on the balance sheet that usually gives me pause. Days of inventory increased by 7 days, putting them at 87 days total. Usually that means products are sitting unsold in a warehouse. Is demand softening?
No, not at all. And it's good you brought that up because management specifically addressed it. The increase in inventory days is specifically because of the 2-nanometer ramp.
How does a new node increase inventory days if it's not a demand issue?
Because the manufacturing cycle time is physically longer. When you move to a more advanced node, like 2-nanometer, there are just more microscopic layers to print, more complex steps. So a single wafer spends more physical time inside the factory as work-in-progress inventory.
Oh, I see. So the assembly line itself is just longer.
Precisely. It's not unsold product, it's just product that takes longer to build.
Okay, that makes sense. But, as financial analysts, we can't just look at the rosy numbers. We have to look at the actual risk profile management flagged in their safe harbor statement.
Right, the fine print. And they do outline some very specific headwinds. They warn about the inherent cyclicality of the semiconductor industry, for one.
Because it always booms and busts.
Yeah, exactly. Plus, intense competition and a huge reliance on significant customers maintaining their order levels. If one major hyperscaler pulls back, TSMC feels it. They also flagged exchange rate fluctuations. The USD to NTD rate remained flat quarter over quarter at 31.60, but it is up year over year.
Which matters because a ton of their revenue is in US dollars, but they report in new Taiwan dollars.
Exactly. So currency swings can completely skew their reported margins.
Yeah. And beyond the financial risks, there is a very specific physical risk here. Under other operating income, there was a jump to 5.27 billion new Taiwan dollars this quarter. And the report explicitly ties this largely to insurance claims from the April 3, 2024 earthquake.
Yeah, that is a stark real-world reminder. We talk about the cloud like it's invisible, but these chips are made in physical factories in a seismically active zone.
Right. An earthquake hits, machines lose alignment, wafers get ruined, and suddenly you have a massive insurance claim on your income statement. It's a huge physical vulnerability in the supply chain.
And this raises an important question regarding capacity management and intellectual property defense in such a highly concentrated industry. That physical risk is exactly why their North American customers are begging them to build those overseas fabs, even if it dilutes their margins.
So what does this all mean? If we wrap this up, TSMC is executing a massive earnings beat driven by HPC demand, early 2 nanometer adoption, and stellar cost controls, all while showering investors with cash from operations and strategic equity sales.
But I'll leave you with this final thought, something the earnings text doesn't explicitly resolve. With North American customers now making up 78% of TSMC's revenue, and the company openly admitting that overseas fabs are currently diluting margins, what is the actual ceiling for profitability? If the 2 nanometer ramp accelerates globally, will the premium pricing of next-gen chips fully absorb the geopolitical cost of diversifying global supply chains? Or will gravity eventually pull that 67.7% gross margin back down to earth?
To stay ahead of exactly these kinds of structural shifts, make sure you follow the show for daily, no-nonsense earnings coverage that respects your time and your portfolio.